Every collapse feels sudden. History shows it's usually the last moment of a very long delay. Welcome to Wheelixon, where history isn't just remembered, it's used to understand how money, power, and systems quietly break. When a financial system finally breaks, the reaction is always emotional. People feel shocked, confused, betrayed. They say things like, "This came out of nowhere. No one could have predicted this. How did everything fall apart so fast?" Applied financial history tells us something uncomfortable. It didn't happen fast. It happened slowly, and then all at once. The idea of a sudden collapse is comforting. It suggests randomness, bad luck, an accident no one could prevent. Because if collapse were predictable, someone would have had to ignore the warnings. History doesn't support the accident theory. History shows that collapse is usually the final act of a story that has been playing quietly for years, sometimes decades. To understand this, we need to change how we think about failure. Systems don't fail when they stop working. They fail when they stop correcting, and that distinction changes everything. In healthy systems, mistakes are painful but short-lived. Bad investments fail, poor policies are reversed, losses are recognized early, pain happens quickly, recovery begins sooner. But pain creates political, social, and institutional risk. So as systems grow larger and more complex, they develop a preference. They choose delay over correction. Delay feels responsible. It sounds careful, measured, stabilizing. Correction sounds reckless. It causes headlines, unemployment, market crashes. So delay becomes policy, not because leaders are evil or stupid, but because delay preserves authority. This behavior is ancient. It didn't begin with modern banks, economists, or governments. It began the moment power realized that truth has consequences. In early monetary systems, truth was unavoidable. Money was metal. If a state spent too much gold or silver, it simply ran out. Promises ended when metal ended. Discipline was automatic, but discipline limits ambition. As empires expanded, wars grew more expensive, and promises multiplied, honesty became dangerous, because honesty forced limits. The Roman Empire faced this problem early. Rome didn't collapse when it first overspent. It adapted. When military costs rose and tax revenues lagged, Rome didn't reform spending. It debased its currency. Silver coins quietly contained less silver. Gold coins became thinner. On paper, nothing changed. Coins still circulated. Wages were paid. Trade continued. Confidence survived. Rome's collapse wasn't sudden. It stretched across centuries. Each debasement felt small. Each adjustment felt manageable. But discipline slowly disappeared. By the time collapse became visible, the foundation had already eroded beyond repair. This pattern repeats everywhere. In medieval Europe, monarchs faced constant fiscal pressure. War required money. Tax systems were primitive. Default meant rebellion. Reform required restraint. So rulers borrowed, diluted currency, and postponed repayment. Collapse was delayed, not prevented. Modern financial systems refined this strategy dramatically. They removed metal entirely. Paper replaced gold. Digital entries replaced paper. Delay became frictionless. Today, reform still exists, but reform has consequences. Reform means allowing institutions to fail. It means markets fall. It means unemployment spikes. Reform is visible pain. Delay spreads pain quietly, so systems delay. This is where most people misunderstand collapse. They think collapse begins with chaos. History shows it begins with management. The management phase starts when leaders realize problems can't be fixed quickly without disruption. So instead of solving problems, they manage perception. They don't deny reality outright. They soften it. They rename it. They frame it. Inflation isn't failure, it's temporary pressure. Debt isn't dangerous. It's sustainable. Banking stress isn't systemic, it's contained. These phrases aren't lies, they're stabilizers. They exist to prevent reaction. Applied financial history shows a clear signal here. When data shifts from discovery to reassurance, instability is already present. At this stage, emergency tools multiply. Temporary measures lose end dates. Rules bend just this once, repeatedly. Exceptions become policy. Interest rates stop signaling risk. Liquidity stops being medicine. The system looks calm. This calm is deceptive. History shows that the period before collapse often feels unusually stable. Markets rise, volatility drops, confidence appears strong. This isn't health, it's suppression of signals. The same tools used to prevent panic also prevent early correction. This is why collapse feels sudden, because correction is postponed until it's unavoidable. Japan offers one of the clearest modern examples. After its asset bubble burst in the early 1990s, Japan faced widespread insolvency. Banks were effectively bankrupt. Assets were mispriced. Growth collapsed. Reform was possible. But reform would have been brutal. So Japan delayed. Banks were supported quietly. Losses were absorbed slowly. Debt expanded year after year. The system survived. Growth did not. The crisis didn't explode. It stretched. Stretching a crisis doesn't eliminate it. It changes its shape. Instead of chaos, you get stagnation. Instead of collapse, you get exhaustion. Europe followed a similar path during sovereign debt stress. Deadlines were extended. Targets softened. Rescue mechanisms multiplied. Each decision made sense individually. Together, they ensured the crisis never ended. It simply aged. This is why people are always surprised by collapse. Because the preparation phase is invisible. It happens in footnotes, in accounting adjustments, in regulatory reinterpretations, in language shifts. By the time reality becomes obvious, the system has already exhausted its ability to manage perception. When delay finally fails, events accelerate. Currencies adjust rapidly, markets reprice violently, confidence breaks. And people say, how did this happen overnight? It didn't. It happened slowly until it couldn't anymore. Applied financial history teaches that collapse is rarely caused by one mistake. It's caused by a long refusal to correct early. Each delay increases dependence on stability tools. Each intervention reduces future flexibility. Eventually, the system becomes fragile to even small shocks. This fragility shows up first in behavior, not headlines. Capital quietly leaves, real assets are hoarded, parallel markets appear, skilled labor migrates. These aren't crashes. They're pressure leaks. History shows that when official narratives suppress truth, unofficial behavior reveals it. This is where counterintuition matters. Most people think collapse happens when fear spikes. History shows collapse happens when confidence has been protected too long. Reform hurts immediately. Delay hurts eventually. Systems almost always choose delay. Not because delay is better, but because delay feels controllable. Understanding this pattern changes how you see the world. You stop waiting for crashes. You stop reacting to headlines. You start watching structure. Are rules bending more often? Are emergencies becoming permanent? Are timelines quietly disappearing? Those signals matter more than price charts. Collapse doesn't announce itself. It reveals itself. And it always reveals itself first to those watching behavior, not narratives. This doesn't mean collapse is inevitable. Delay can buy time, but delay without correction doesn't create stability. It creates fragility, and fragility always breaks under pressure. History doesn't repeat loudly, it repeats quietly. By the time everyone notices, the preparation phase is already over. And that's why collapse never feels fair. The cost doesn't fall on those who delayed reform, it falls on those who trusted stability. Applied financial history isn't pessimism, it's pattern recognition. It shows that systems don't collapse suddenly, they collapse after exhausting every option except honesty. If you understand this, you stop asking, when will the next collapse happen? You start asking, what has already been postponed? That question always leads to clearer answers. If you want to understand money and power without panic, noise, or prediction, subscribe to Wheelixen.